So let's say your friends are in town and they need a car. They want to rent a car. Now, you check in the market and you find out that, well, yes, you can get a car on rent for $2,000. And you think, you know what? I see a business opportunity here. What if I buy a car? I buy a car today and I give it on rent to my friends. And then when they will go back, because they're in the town for whatever reason, when they will go back, I will get my car back and sell it. So let's say you buy a car for $20,000 and you give it on rent to your friends for $2,000. And when you get your car back, you're able to sell it for $21,000. Because of whatever reason, prices went up, and your used car was sold at a higher price. So, was it a good news or a bad news? Well, you invested 20,000 when friends came to the town, and when they left and you got the car, you were able to sell that car for 21,000 plus you have 2,000 the rent. 2,000 was the rent that you got from your friends. So good news, now you have $23,000. See? So that's a good business. Your $20,000 have become $23,000 without you doing anything. So you have made $3,000. Now, I mean, there are various names for that, and I will stick to what is needed from CFA exam perspective, and we call this return. So this is different than the word return that we use. For example, your friends have returned the car, but that's English. So same word can appear in different contexts in English, in investment. So here, from CFA exam point of view, the word return refers to how much you have made. In this case, you have earned $3,000. Nice, right? So you have earned $3,000. Now, when typically we talk about return, we actually refer to rate of return. Though you won't see this written as rate of return, but actually the word return refers to the rate of return, which is simply you divide it by 20,000 and you multiply it by 100 and you get a kind of number that's in percentage, and that's 15. We write this as 15%. So that's the return on this investment. Remember, this is investment. I'll not go into technical of that. We'll do that in equity, why it is investment. But for now, because we are so close to the exam, I want to know, I want to focus on, and I do not want to waste time. So let's focus on this. So this is an example of an investment in which your rate of return or simply return was 15%. So it can be quite confusing. Is return the dollar return or is return the rate of return? Well, for now, just go with what I'm telling you. And remember, I've done it for 20 years. So go with 15%. So if it says what is the return, it's 15%, which can be written as this. Or the other version is where you do not multiply it by 100. So you can simply divide 3,000 by 20,000 and you get 0.15. Both are very valid. So an exam, be ready to select A. This is correct. And if you have a choice B with 0.15, that's also correct. So which one, A or B? Well, both are correct. So they won't be there. If they're both there, then the question will ask something like this: which of the following is not a return? And you may have another number C, which will be the correct answer. So both are correct way of writing the return, which is actually different to rate of return. See? Okay, so this was your first out of 24 topics that I think you need to know, as I was talking about earlier. So this is the first topic. I'll keep on writing the topic number. The first number is which topic I am teaching, and the second number is how many total topics in quantitative topic area I will teach. So this is the first topic. It's called rate of return or return. And by the way, you made this money, this 15%, over what time? I did not discuss that. Was it a month? Who knows? A quarter? A year? I did not talk about. All I said, you made 15%. So whatever was the period, which we do not know in this case, your return was 15% in that rate of return. But I'll keep on calling it return. Okay, so what were you doing during this period? Were you driving car for them? Not at all, obviously. You were not doing anything. All you were doing, you had given up your money, which we will call P naught, at time zero. Zero is for so time zero. You had given up your money. Not sorry, this to the I'm going to mistake. This 20,000. So this is P naught. How much you gave up of your dear money? You gave up 20,000. That's called P naught. And you did nothing else. You just were patient and waiting. And we will say in investment that you were holding your investment. You are holding your investment. So what you've got is called holding period return. The percentage rate of return that you make during the period during which you are holding your investment. You're holding your breath in the hope that nothing happens to the car and you do not have to go to insurance company and your friends are also fine and they do not get into trouble because car breaks down and they complain. No, you're not holding your breath. You are just holding your investment. You are not asking your friends to sell the car and give the money back. No. So you got rewarded for holding the investment for being away from your money for the period. So that's called holding period return, also written as HPR. So what about the formula, the crazy looking formula? Nothing. It's simple. I'll use a different color to just make sure that you get it. So this one was P naught. So I'll write P naught. So P naught is what you gave up. P1 is what you got back by selling the car. And D1 is the cash flow. Sometimes D1, sometimes you will see CF1 or simply CF. So we can skip the one part. One here is when you got out. Zero is when you got in. One is when you got out, end of the period. So I can write this formula. I'll first write numbers. You already know this. I'm not doing anything new. I'm just connecting the story with numbers. So you have 21,000, which was the price for which car was sold, minus the price for which car was purchased. And then you also got the rent, 2,000. And that gives you your dollar return if you calculate this, and then you just divide it by your original investment to convert it into percentage. If you just do the numerator part, this part, you will get the dollar return. But we need the percentage return, so we divide by 20,000, and that gives us 15%. No, sorry, it gives us 0.15, and then you multiply it by 100, we get 15%. So now I'll write the formula, which is pretty simple and easy for you. So this is P1 minus P naught plus cash flow or dividend. In case of if you had invested in stocks, then that would be called dividend. But cash flow works fine and divide by P naught. See, pretty simple, straightforward, holding period return. So now from exam point of view, one thing you need to know is that sometimes they don't provide like this, but there's so many things that they can ask. They can ask, for example, how much was your income return? What the hell is that? Income return. Is it holding period return? No. Do not assume that. Do not assume. It's called income return. What does that mean? That is just what you earn in terms of income. What does that mean? Well, if you look at this formula, there are two parts to it. One is how much you made from change in price. Because remember, the car went up. The good news, you see, the car price went up. This is where the price was at the end of the investment. So you sold it for 21,000. You bought it for 20,000. So you made some money because of the prices going up, which obviously were not in your control, but still good news. You made that money. But you also earn because of the contract, because of giving car on rent, you made 2,000. So what if market prices had not gone up? Well, you would have earned at least this. And this part is called income return, which in this case would be 10%. 2,000 divided by 2,000 divided by 20,000. That's the income return. And what is the capital gain? Capital gain. That's another term. It is also called price return. The return that you made, return, remember, by number, you guessed it, we are using in terms of how much you made. So the return that you made from change in price is called price return, also commonly known as capital gain, but price return will do. So income return was 10%, price return was how much? Well, very simple. Because the difference was $1,000, you earned $1,000 over investment of $20,000. $1,000 is the difference between 21 minus 20,000, and that's 5%. So in total, the holding period return was 15%, out of which 10% was the income return and 5% was the price return. So yeah, that's it. And this holding period return is also known as total return. So why students lose marks in this topic? Because they do not read the question. So once you're given this data, and investment was made for this, was sold for this, they will catch your whole law. Read the full question to find out what they want you to calculate. Maybe you are required to calculate income return. Maybe you are required to calculate just the price return. So it is quite possible that all of the data will be given, and then you'll be asked, what is the price return? Well, what was the point of giving so much data if they wanted to know only price return? Yeah, they will have to fail some students, right? Remember this. They have to fail a lot of students, particularly those who do not read the question properly. So you will be given data like this, and then at the end you may be asked, what is the price return? Correct answer, 5%. What is the income return? Correct answer, 10%. What is the holding period return? 15%. What is the total return? 15%. Why are there two names for the same number? Well, you do not get to decide that. You just learn that, answer that, move on. Don't waste your time. So that was one out of 24 topics in quants that I think you need to know as a minimum to pass the exam. Now, let's move to the next topic. By the way, is it a good investment? Uh, like, is it good enough? Like, how we know that? Well, you had money. What you could have done with that money? You could have invested that money with the bank. Oh, yeah. So did you make a right decision? Well, that depends on what bank would have given you, because you took a lot of risk. Remember, the car price going up could have gone down. So going to bank would have avoided all that risk, because you would have a sure locked investment where you would get a fixed amount at the end. But would it be better than this? Well, that depends on what bank is offering you. What does that mean? Bank will give you certain return. Let's say bank is offering you 20%. Oh, that's strange. So I could have won 30% just by giving money to bank, but I won 15% by taking all this risk. Hold on. That was 20% per year. And this one, well, we did not define it. So now the second topic is how you convert holding period return into an annual return so that you can compare it to a bank rate and then decide whether it is worth doing all this or not. What? Let's move to the next topic where we convert the holding period return into an annual return so that we can compare it compared to a bank rate. Okay, so let's move to the second topic. This is our second topic out of 24 topics of quants. Okay, so continuing with our example where we generated holding period return of what was 15%, right? 1.5. But we did not know over what time it was earned. We want to compare to a bank rate. I'll just call it bank rate, but obviously that's incorrect. I will be writing a lot of incorrect things and using terms. So if you are a CFA and you are watching this, just move on. This is not for you. This is for students. So I'll be using a lot of non-finance and non-investment and non-CFA terms, but I will tell you so that you do not confuse these. There is no such thing as bank rate in the CFA exam, but we know what it is a bank rate, right? So I'm writing it here, but later on we will fix it and we will learn the proper name and and we'll talk about fixed income and everything. But for now, bank rate, you know what is bank rate? The rate that bank gives you. You go and give your money to bank, and these rates are always for the full year. So if it says 20%, it actually means 20% per year. So, but it will simply say 20%. But you understand that means that if you give bank 10,000 now, after 1 year, the bank will give you back your original plus 20% of 10,000. 20% of 10,000. So you will get back 10,000 plus 20% of 10,000, which is 12,000. So that's what this bank rate. Okay. So how was your investment? Was it good? You made 15%. Over what time? Okay, now let's bring in the time of the period. Let's say this investment was for about 6 months. Okay, so that's nice. And within 6 months, you were able to earn 15%. So compared to an annual return of bank rate of 20%, this looks good. Why? Because you can repeat it. You can do it 2 times. You can hit your money, and within a year, you can do it 2 times, and that will allow you to earn 30%, which is better than 20%. But hold on. We need to also understand that at the end of the first 6 months, when you will get back, you'll not get back with 20,000. Yes, you started with 20,000. I'm just writing numbers on a line. So 20,000, but by the end of 6 months, let's say this is 6 months, this is at 6 months are ending, and you got back 23,000. So for the next 6 months, you can actually invest that additional 3,000 as well. So for the next 6 months, so let's say this is time 0, this is 6 months, this is 12 months. So for the second 6 months, not only you are investing your 20,000, you're also investing the extra 3,000. You're making money on that. So actually, you will make slightly more than 30% in this business of buying cars and giving cars on rent. CFA Institute wants to know to be exact how much. So let's learn. How do you convert that 15% into an annualized rate? There are various names for that, by the way. Warning here. Sometimes all professionals make things complex just to indicate that they are complex, but they're not. So you'll see a lot of names for this. I'm calling it annualized return. Annualized return. But later on, we will fix this. There are many names for that. Annualized return. Also, oh yeah, I don't want to go into that. So let's just call it annual return at this stage. Annual return or annualized return. So annual return. How do you convert holding period return into an annual return? You add 1 to it, the decimal number, not the percentage. So holding period return, you add 1 to it. And then you do this. We don't need to know the formula. You won't be writing the formula, but it helps in terms of how to use calculator. So I'll explain how to do on calculator. That's what you need to know from exam point of view. And you do 365 divided by 180, and then you do -1. And yeah, this is how you convert holding period return into annual return. What is 365? As you know, number of days in the whole year. Okay, what is 180? A number of days in our investment period. We invested in this car business for 180 days. Wasn't it 6 months? Yeah. If there is no other information, assume 6 months is 180 days. It's level 1, so you won't be strict on that. So if it is 6 months, assume it is 180 days. If it is 3 months, then it is 90 days. Okay, so let's do it. So 0.15, remember always in percentage. So it's 0.15. So 1 plus 1 or plus 0.15 all raised to power. How do you do it on calculator? That's what I'm going to explain. I'm not a teacher, I'm a coach. I'm going to help you how to do it. Divide by 180 and then all of this minus. So how do we do this on the financial calculator? I have this Texas Instrument BA2 Plus. I do not like the HP one. I've never used it. I've tried a couple of times, but I just do not like it. But I'm sure I have students who like it. So that's your call. But I'll be using Texas Instrument BA2 Plus in all these lectures. So what you're looking for is this key y raised to power x that is above digit 9. So if you look at the calculator, there's digit 9. Right above that, there is a key y raised to power x. This is the one that you need. So this one is the y part in this key, and this one is the x part. And this is what we want, y raised to power x. So how we do this? Well, there are a couple of ways to do this. I'm explaining the method that I like, but there are other methods as well. So let's go with this one. First step, you type 365 and then you divide it by 180 and you press is equal to. So I'm doing this on the calculator while I'm doing this. I initially thought of recording a video, but then I thought, hold on, it's not that complex. So 365 just divide by 180 and is equal to, and your calculator should be displaying now 2.027777, whatever, depending on how many decimal places you have. So now what you do now is, next step is, on the left side, you can see that on the left side column, there are buttons. The bottom is CE/C to clear. Above that, you have RCL. And above that, you have STO. STO stands for store. We need this one. So your calculator is now displaying 2.02777 or whatever, 2.028. Just press this STO and then press 1. Basically, you are storing this number at location number 1. So the calculator is already displaying 2.0277. You press STO and then you press 1. So you have just stored. So basically, what you have done is, once your calculator is displaying 2.027 and you press STO and you press 1, so you are storing this at position number 1. Okay. Now what? Okay, just press CE, clear it, everything, clear. Now let's start. So your calculator is now displaying 0. You do 1 plus 0.15 is equal to, you do 1 plus 0.15 is equal to 1.15. I'm doing it with teaching to make sure that I do not skip a step. So now my calculator is displaying 1.15. Now that's the y part. So you've already calculated y. Now we want to raise it to x. How you do that? So once your calculator is displaying 1.15, you press y raised to power x, this key that I was talking about earlier. Now you press it, and so you're telling the calculator that I want this y to be raised to the power x. So you have done that. You press the key. Now you need to tell the calculator what is x. Well, it is already stored at position number 1. So how do you get it back? Recall 1. This key, RCL. So press RCL and then press 1. So recall and then press 1. Your calculator will be now displaying 2.027 or 2.0278, whatever. Does not matter at this stage. And then you finally press is equal to. There you go. Your calculator is now giving you 1.328 or maybe 76, whatever. So you've done this part. Excellent. Congratulations. Many students struggle with this so long. Okay. Now final step. Just -1. So you do -1 is equal to, and you get your decimal answer of how much you earn in a year, 0.3276. And if you want to convert to percentage, all you have to look at this in the same column where you have C, RCLs, STO. If you go all the way in the middle, you will have you'll have a key percentage. So simply, if your calculator is already displaying 0.3276, just press this percentage. No, sorry, no, don't do that, don't do that. Oh, that's my mistake. It was to convert a number into percentage. No. You multiply it by 100 and you get 32.76. If you already have 32.76 and you wanted to convert it into 0.3276, then you would use this percentage. So the percentage key is to convert into percentage, not out of percentage. Anyway, sorry about that. So 0.3276 multiplied by 100 gives you 32.76. Go. And that's your annual return or annualized return. This is how you convert holding period return into annual return. What if the holding period was more than 365 days? What if it was, let's say, 2 years, 3 years? Then what? Yeah, just simply replace this number with whatever is the holding period number of days. If it is 2 years, then use 720 here. Yep, that's it. Just that simple. So the formula works for 3 months, 6 months, 1 year, 2 year, 3 year, 5 year, whatever. Just remember that this lower number that you use as your denominator here is the number of days for which you were holding the investment, right? So yeah. No, okay, great. What else? Yeah, a few more things you need to know about this topic before we move to the next topic. Okay. So what if you invested 20,000 and after some time, let's say after a lot of time, it went up to 44,000. Right? Nice, good investment. Your investment turned into 44,000. And let's say it took 5 years. So how much was your annual return? Hold on. What? Yeah. Okay. So can we still use this formula? Yeah. Oh. What was your holding period return? Holding period return. Oh, so 44,000 minus 20,000 divided by 20,000. Right, there is no cash flow in this case. There is no rental income. So it is very simple. Otherwise, it would have been something here, but it is plus zero. So you get what? 44,000 minus 20,000 that's 24,000 divided by 20,000, and you get 120% or 1.2. Great. So in terms of percentage is 120%. You got 1.2. Okay, now what? Let's put it in the formula. 1 plus 1.2. Remember, it's 120%, so 1.2 raised to the power 365. Or what I can do is, because 1 year divided by 5 years. I could have done days, but I will work this way. And then minus 1. Yep, it's that simple. So 1 plus 1.2 is 2.2. And 2.2 raised to the power. So there are many ways to do this. 2.2 raised to the power 1 over 5. By the way, 1 over 5 can also be written as 0.2 minus. So I can also write this way. So as I mentioned, there are multiple ways of doing the same thing. So I'm not explaining another way. 2.2 raised to 2 minus 1. So while we do this, 2.2 y raised to power x 0.2 is equal to minus 1. That gives you 17%. Isn't it different this method different compared to what I did earlier? Yeah, I thought I should actually in both methods. You could have used that method earlier that I did here, all of this. Yeah, well, this one also works. So in the end, you get 17%. Okay, so when you invested 20,000 and after 5 years, this investment became 44,000 over a 5-year period. Your holding period return was 120%, and your annual return was 17.08%. And that is also called, there's a very interesting name for that. Hold on. You're going to use this a lot in finance. It's called CAGR. What does that mean? Cumulative annual growth rate. So in exam, here I'll calculate CAGR. It is nothing complex. It is what you have already done. 17% is known as CAGR as well. Cumulative annual growth rate, which in this case is 17%, 17.08%. Okay, yeah, same formula, yes, exactly same formula. That's what I've used. I've used slightly different way of doing it on calculator, but same formula. And using the same method, you would get the same answer. Okay, so that's called CAGR. And there is another name for it. Before we move to the third topic, one final point. This CAGR is a way of what we call calculating geometric average or geometric mean. What does that mean? Well, that's our next topic number 3. So, see you there. Let's move to the third topic. If you want to take a break, I recommend you can take a break now. So basically, that's the whole idea that I've divided it into 24 topics. So if you're short of time, just watch videos for one topic and then take a break and then come back and then resume with the third topic. So you won't have to worry about minutes or where I was. So yeah, so this is how I'm going to to explain the whole set of 24 topics for quants. Okay, let's now move to the third topic. Okay, so now let's move to our third topic. So that would be third out of 24 topics that will help you in passing the exam. Okay, for quants. Okay, so in our business of renting cars, we earn 15% for first 6 months, and then we reinvested. What does that mean? So we sold the car, we got the money, and then we invested money again for next 6 months. And let's say we got same 15% in this second investment. So at the end of the year, we did not have 30%, rather 32.76. If you add 15 plus 15, that would be 30. So how we got 32.76? Because in the second investment period, we were earning 15% not only on the original investment of 20K, but also we were earning 15% on our profit of 3K that we made in the first 6 months. So the result is that by the end of the year, our returns are 32.76%. We've already done this. We call this annualizing the rate of return. So we got 15% holding period return in the first 6 months, and then 15% holding period return in the second 6 months. But magically, it becomes 32.76 because of here something is being done. What is being done? That we are not only investing our original money, right? We are also investing now in the business, the profits. Okay, so we've already done this. Nothing new here. The next question is, what if the second investment was made at 20%? Somehow you were able to find people who wanted to rent cars at better rates, or maybe the price of the car went up. So what if you have a different holding period return for the next 6 months? So 15% for first 6 months, and then 20% for the next 6 months. So how much is your annualized return? So how do you annualize in the case when you have different holding period returns? Very simple. 1 plus, you just add 1 to the first return, and then multiply it with 1 plus the return for the second period. That's it. And then you do -1. And that gives you the answer. So I'm doing it on calculator because obviously it's not just teaching. I have to make sure that you can do this. I'm multiplying 1.15 multiplied by 1.2 is equal to, I get 1.38. And then I do -1. I get 0.38 multiplied by 100. That gives me 38%. Very good. So this is how you analyze the holding period rate of return if you have different rates. Okay, great. And this one is called, it has another name. It's called time-weighted return. Rate of return, or simply time-weighted return. Yep, time-weighted. So time-weighted return. Okay, why? Well, that's not the point. The point is that if you analyze rate of return like this, the number that you get, it's called time-weighted rate of return or time-weighted return. Okay. Is that enough for passing level 1? Yeah. Yeah. But why? Well, it's level 1. You don't need to worry about why, unless it is mentioned by teacher of the book. Forget it. And in this case, there's no book. So I'm telling you, just remember this, that if you have different holding period rate of returns, how you analyze this. So this is the method to do this. And there is another name for that. That's called time-weighted rate of return. Okay, I can remember that. Yeah, nice, good, good. See you in level 3, where you will learn in more detail what is time-weighted return. Okay, that's it. No. There is more. This was about 6 months and then 6 months. So I'm modifying the story. What if you had invested for a full year, let's say at 25% in car business, got your money, and then invested for a full year, and then invested for a full year. So what if we are talking about a 3-year investment, 1 year, second year, third year, and holding period return in the first year was 25%. Let's say it was 22% in the second year. Again, holding period return. And then finally, in the third year, let's say it was 20%. So things are not looking that good for this business because it's going down from 25 to 22 and 20, but that's okay. So holding period return for the first year, holding period return for the second year, holding period return for the third year was this. So how much was your annual return? So how do you annualize if you're given holding period returns which are relevant for a longer investment period, more than a year? Well, here is one interesting fact. Actually, this formula they've already used has something else, which I did not write because I did not need to. Okay, so, and this one, all of this raised to power 1 over investment period. So will it change the answer that we got earlier, 38? No, not at all. Why? Because investment is how long was the total investment? Well, in our earlier example, there was 6 month investment, then 6 month investment. So total investment period was for 1 year, right? So 1 over 1. So now we use the same formula. Look here. So I'm using the same formula, but now that pink bracket will have something useful. So 1 plus 25% multiply by, you use the same method. Multiply by 1 plus 22% multiplied by, take a note, it's not plus, it's multiplied by 1 plus 20%. Okay. So, and then this, we'll just, okay, so 1 can drop, okay. Okay, what else? -1, yeah. What else? The pink bracket? Okay. So what do you do? This, you do this, and what do you get? 1 over the total investment period. By the way, you can do it in days, number of days, or in this case, number of years, it does not matter. It's level 1. You get a lot of relaxation from CFA Institute. So 1 over 3. Okay. So what we will get? We will get an annual rate. Oh, so previously we were going from 6 months to a full year, and now we are going down from 3 year to a full year. Yeah, we are going down from, so we have rate for 3 years, and we are trying to calculate an annual rate, kind of an average rate. Oh, okay. So what do we get? Oh, I'll do it on calculator. I don't know. I'm creating these numbers on the fly, just thinking and trying to make things easier. So I do not know. So I'm doing it on calculator. You can do it with me. So just make sure that you get the same answer. So 1.25 multiplied by 1.22, which is 1 plus 22%, multiplied by 1.2 is equal to. So make sure you're following the sequence of pressing keys on that I'm actually. So you get 1.83. So all of this, all of this comes out to be 1.83. So I'll write it here. So 1.83, and then we have to raise it by 1 over 3 and minus that. So how we do that? So once your calculator is displaying, by the way, we know this. There are many ways to do this, but I'm going with one of the method. Don't tell me that it's not the best method. I'm sure there are other methods, and depending on which one you're comfortable with. So obviously 1 over 3 can be written as 1.33 minus 1. So how I'm going to do it? On calculator, it's saying 1.83. I haven't done anything. I just got 1.83. Now I press that key of that y raised to power x. There is key appear. above digit 9. So if you look at digit 9 above that one. So basically what I want the calculator to do is currently the calculator is displaying 1.83. So then I'll press this key. So the calculator knows that this is the y. So at 1.83 y raised to power x. The calculator got okay. And now calculator is looking for x. So it is x. So 1.83 and then press y raised to power x and then type 0.33 and then press is equal to. And here you get your answer, 1.2207. I'm repeating. So if your calculator is displaying 1.83, you press the key y raised to power x, and then you press 0.33, and then you press is equal to. And then final step, as you can notice, there is a -1. So you do -1, so you get 0.2207, or in terms of percentage, 22.27%. Right. So if you are investing in business in which you earn 25% the first year, 22% in the second year, 20% in the third year, again, assuming that whatever you earn in the first year was also invested in the second year. So in second year, you not only invest the original money, but you also invest in the profit that you made in the first year. And then in the next year, you invested real money, money plus profit of the first year, plus profit of the second year. All of this was invested in the third year at a rate of 20%. So we get 22.07. What does this mean? This means that on average, you have earned 22.07%. Wouldn't it be simple just to add 25 plus 22 plus 20 and divided by 3? Yeah, you could have done that, and you would have got one answer, which would be one of the choices, and it will be incorrect because this is not how you do this. Why? Well, doing this has a name. It's called arithmetic mean, and we are not talking about that. But do you get the same answer? No. Let's try that. 25 plus 22 plus 20 divide 3. You get what? 15.67. Yeah, that's incorrect. 15.67. Yeah. No, that's not the way to do it. This is the way to do it. Okay. So if you're given holding period returns for multiple years and you're asked to calculate the average return for 1 year or analyze it for 1 year, you do it this way. And is it also time-weighted return? Yes. Yep. The name applies regardless of whether you are using 6 months plus 6 months to get the full year return, or you are using data of 3 years to get 1 year return. If you use this formula with the pink bracket, the number that you get is called time-weighted return. Okay. Yeah. What else? Is it over? No. One last point. Now, what is the biggest hurdle in passing level 1? You think of employer and CFA Institute as your teacher, and you think that you are in university. You're not. You are not in a university. CFA Institute is not an education institution. CFA Institute is an institute created by employers to fix what is wrong with the university. So they're different. Okay. Yeah, so what does that mean? That means just learn what is being told, correctly answer the question, and move on. Eventually, you will learn everything. Okay. So yeah, there was one thing very popular in exam related to this time-weighted return. And what is that? Okay, I'll use a different color so that you can remember it. Okay, I'll use this color. When to use it? Well, when the fund manager has no control over timing of cash flows, of, of investing cash flows, of investment decisions, timing, has no control. What I'm talking about, no control on timing. Well, a fund manager cannot decide when to invest and how much to invest. Really? So what kind of fund manager he is if he cannot decide when to invest? Well, think about it. If you are managing money for clients, you can only invest money if the client gives you money. So who decides to when to invest? Client. Because unless you get the money, you cannot invest it as a fund manager. So mostly fund managers do not decide and do not have any control over timing of investment cash flows. They can only invest once they get the money, and they get the money only when client decides. And similarly, if client decides to take money away, they have to sell. Fund manager have to sell whatever investment they have and give cash to the client. So it is client who decides when to invest, how and how much to invest. So typically fund managers do not have control over timing of investment cash flows. And that's when they should use time-weighted rate of return. Right. So if you have no control over time, you should use time-weighted return. Yeah. Doesn't sound correct. It is correct. Really? Yeah. I'm repeating. If the fund manager has no control over timing of investment cash flows, then the appropriate method to calculate annual return, to calculate the average return, is time-weighted return. That is so difficult to remember because it does not make sense. Yeah. Tell those who are studying and they're trying to make sense and not realizing that more than half will fail level one. Yeah. So, okay. Can I explain more? I would love to, but you know what? That would be absolute waste of your time because it won't be tested in the exam. You'll feel happy. I'll feel happy. We'll both be happy that we are learning. We are learning. We are learning. We are becoming enlightened. We know so much, which is worthless, useless in the exam. That a level one. We'll do that in level three. I hope you are there. I hope you are watching my level three lectures. And then you will understand all of it. Okay, so that completes our third topic out of 24 topics. And maybe you want to take a break. Or maybe no. Your choice. Welcome to video lectures. Pause, repeat, play, whatever. Okay, let's move to the fourth topic. Okay, our fourth topic out of 24. Let's say I'm a fund manager and I do great in a year. Let's say first year of my fund, I earn 100%. Yep, for my clients, I earn 100%. I double their money. Second year is not that good. I actually lose 10% for my clients. So this was year one. This was year two. Now, what would you say? How much I earned on average? Well, 100 plus 100 minus 10 divided by 2. So roughly on average, my return is 90% over 2 years, so 45%. Not bad. Not bad. On average, 45% is pretty decent return. Now let's say there was a big client who was not that sure about my performance in the first year. So he gave me only $100 to invest. So $100 came into the fund. So this is about the fund. Fund performance, fund money. So $100 came in. And obviously for him, it was $100 going out. $100 was going out. It came into the fund. And by the end of the year one, it had doubled. I did not give him back that money. I just called him and informed him or sent an email that, look, this was a great year. I've doubled your money. It's value. So let's say this is the value, market value. Market value of these investments have gone up from $100 to $200. He was so happy. that he said, you know what, I'm sending you another $1,000 to invest. Obviously, he did not know how second year will be. He assumed the second year will be as good or at least nearly as good as year one. So what happened, because I got that $1,000, again, negative for him because money is going out of his investment account or his bank account and coming into my fund. I already had $200 worth investment. So this total investment became $1,200, which went down by 10%. So by the end of the year, the money that I had for him, and I called him and I said, you know what? The $1,200 that I had at the start of the year has actually gone down by 10% to 1,080. That is basically $1,200 into 1 minus 10%. So we can do this $1,200 into 1 minus 0.1. And that gives us $1,080. And he was not happy. And he said, you know what, send me my money back. So he got his 1,080. Now, if you look at his point of view, he actually made nothing because he gave me 1,100, 100, and then 1,000, and he has not even received back his original money. So let's say we are sitting in a club and I'm talking to a potential new client. I'm trying to convince him that I'm a good fund manager and this new client should invest with me. And I tell him, look, over the last 2 years, obviously not 2 years, maybe 5 years, maybe 10 years, but to keep it simple, I'm just talking about 2 years. Over the last 2 years, I earned on average 45%. And the big client says, you know what, not for me. You have earned nothing for me. Actually, you have lost money for me. Now that's interesting because he's right. He did not even receive his original money. He gave me $1,100, $100, and then $1,000. And he has got back only 1,080. He has actually got less than original money. So he will say, what are you talking about? Now, if he has understanding or if he has a professional manager, he will calculate a rate of return and he will say that this is what my rate of return is. It's not 45% per year. It is something else. And it is negative actually. Oh, yeah, that's a problem. But why it is happening? Well, you can see that though in terms of percentage, the second year was not that bad, 10% was not that bad, but he had more money invested at that time. So in terms of dollars, this 10% was a big problem, big loss, because it was being incurred on a $1,200 investment in total. $200, the original investment plus $1,000 new investment. While when 100% gain was being earned, it was only $100. But you know what? That's not my fault. I did not decide that how much money should be invested in a year or the second year. So I should not be judged based on his negative return, whatever it is. Let's just call it negative return. But he will be also fair from his point of view. He will say, you know what? On average, this fund manager has lost money for me. I got negative return. So who is right? Well, you need to understand the negative return that he got in percentage is called money weighted return. And why it is negative? Because more money was invested in the second year. So the calculation of this return automatically gives more weight to the year, to the performance of the year in which more money was invested. Now, despite the fact that year one was 100% positive, while year two was just minus 10% negative, but still this minus 10% will be given more weight because more money was invested in the second year. So client may say that, you know what, for me, you have earned this much. Now, as far as I'm concerned, I'll say now my return is, but I will go with roughly a number close to 45. We have learned in the previous section a time weighted return. So I will use that time weighted return, which will be 1 plus 100% into 1 minus 10% minus 1. So whatever it comes out to be, I will be using this. And use, sorry, you can see in the calculation, there is no role of how much money was invested. It's not being even considered here. So it will come out to be close to 45%. Let's do this. Okay. 1 plus 100% is 2. 2 into 0.9 is equal to this minus 1. Oh, sorry. I missed this part. All of this raised to power 1 by 2. So anyway, 1 plus 100% is 1 plus 1 is equal to 2 into 0.9 and then raised to the power 0.5. So by pressing y raised to power x, and then 0.5 is equal to, I get this, 1.34, and then I do minus 1, so I get 0.34 or 34%. So not that close to 45, but still positive. But the client will say, no, this is not correct. I've lost money. I will say, you know what? That was because of two things. Because of how, as a fund manager, we performed, and also your decision to invest less money in the first year and more money in the second year, and that was your decision. So we are not responsible for that. We have no authority over that. If you had invested all of your money at the start of year one, then your return would have been 34%. Anyway, so this topic, the fourth topic is money weighted rate of return. It is unlikely that you'll be calculating it. When I say unlikely, obviously I do not have private access to the actual exam paper, but what I can understand, obviously over the last 20 years with thousands of students, that questions are not time demanding. So questions do not require more than 90 seconds. Sometimes there are a few questions, but then my understanding is those questions are not even worth wasting time. You should just skip those questions. So maybe one or two questions in the whole exam would be more time taking, but otherwise questions do not take time. So I do not expect you to do this calculation of money weighted rate of return, but if you come across questions while you're doing practice and you want to know how to do this, so like I'm going to explain now how to do this. You need to know these cash flows, which are pretty straightforward. How much went out and how much came in from client perspective. By the way, if you think from fund perspective, all you have to do is switch the sign. So from fund perspective, $100 came in, $1,000 came in, and then $1,080 went out. So either way, you can use either set A or set B. Both will give you the same answer. So let's go with the client side. And now what we are going to do is we are going to use financial calculator. You look at the calculator, the second row, not the first, the second row from the top. Second row from the top. Second button is CF. So you press this button, CF. This will activate the cash flow worksheet. And maybe you already have some data, so it is better to clear that. So you press the second function and go all the way down and press CE over C. So after pressing CF, just press second function CA. I'll be doing it while I'm teaching here so that I do not miss any step. So I press CF and then I press second function CE to clear. Now my calculator is displaying what is displaying. Currently it is displaying CF0 is equal to 0. What it is saying is that cash flow at time 0 is entered as 0. So we should enter a correct cash flow. We know the cash flow at time 0 was 100 negative. So how you do this? You type 100 and then all the way at bottom, next to the C, there is a button of 0. Next to it, there is a decimal. And next to it is a plus minus. This is a button or key for changing the sign. So after typing 100, you press this plus minus sign. So you type 100, and you press this plus minus sign. That will make it a negative number, negative 100. So your calculator will be displaying negative 100. And then you go all the way up. Right above this cash flow button, there is a button of enter. So you press this. Once you press enter, you will see that this display will now show cash flow times 0 is negative 100. You just entered this as a cash flow at time 0. Okay, now what? Now, next to this enter, there is a key of up arrow. And then there is a key of down arrow. So just press this key of down arrow. And you can see the display now changes to C01. The display now changes to C01, basically, which is cash flow at time 1. And currently it is 0. But we know cash flow time 1 was 1000 negative. So we repeat the same process. We type 1000 and then we make it negative. So we type 1000, then we make it negative. 1000, then we make it negative using this key. And then we press enter. So you have entered negative 1000 as cash flow at time 1. Great. Now what? You press down again. The calculator displays F01. For now, ignore it. We do not need it. How do you ignore it? By pressing down again. Just press down again. Now it says C02. This is what we need, C02. What is the cash flow at time 2? And we know cash flow at time 2 means at the end of year 2. This is the cash flow. So what we do, we type 1080. We do not need to make it negative. It is a positive number. And now what we do, we press the enter button. Say enter. Press enter. Great. We have entered all 3 cash flows. All 3 cash flows that were needed have been entered. Now what? Now, if you look at this, the calculator, to the right of this cash flow, there is a button NPV. Ignore that. And then to the right of that is IRR. You press that IRR button. Okay, so you press that IRR, it says 0, no problem, because it has not computed yet. So on the left top, you have CPT. Just press CPT now, and you get your money weighted rate of return of negative 1.67%. It is already in percent, so you do not need to multiply by 100. Okay, great. Why calculator is not calling it MWR and is calling it with another name, IRR? That's not your problem. You have just learned how to calculate money weighted rate of return. Isn't it great? No, it is not great because it won't be in the exam. But yeah, it will be in practice questions. So you may feel that you need to know it. I'm not guaranteeing, by the way, anything. I do not know what will be in the exam or not, but I think it will not, because it requires a lot more than 90 seconds. Even with financial calculator. My understanding is that you won't have anything that requires that kind of time. Okay, so we have just learned money weighted rate of return, how it is computed. One trick that you may come across can be dividend. So sometimes something like this, that this investment in the year 1 paid a dividend of $4, which was reinvested. So that, if this whole story was same, the only change was that this $4 was reinvested, that does not impact the calculation, because no impact on the cash flow, no impact on the cash flow, no impact on the cash flow. I'm assuming that this $4 investment did not change anything, and obviously the return was not 10%. So the key thing is how much cash was going into the fund and how much cash was going out of the fund. That will determine what is money weighted rate of return. But if it says that there was a dividend of $4 which was sent back to the investor, then that means this cash flow will need to be adjusted, because $4 came in for investor, $1,000 went out. So from investor point of view, it will become net negative of 996. And that would affect the calculation of money weighted rate of return. Okay, so this was your money weighted rate of return. Key thing is that the number is sensitive to timing. The key thing is this number is sensitive to timing and amount of cash flows. Yep. And that is determined cash flows going into the fund and going out of the fund. And that if that is being decided by the client, then it is unfair for the fund manager to be assessed based on money weighted rate of return because he has no role in deciding the time and amount. Okay, let's move to the next topic. Okay, let's move to our fifth topic. This is the fifth topic out of 24 topics of quants. Okay, so let's say you have 10,000 and you go to a bank and you invested 10%. So let's say this is time now, and this is the first year, and this is the end of year one. So this is time 0, which is now. This is year one, and this is the end of year one. End of year one. Now, we typically do not write this, and we also do not write this. We simply write 1 or T1, and that should be now the standard that if I write T1, I'm talking about the end of the year. So this is the year, and this is the end of the year. So how much you will have? Your 10,000 will grow by 10%. Then you will have 10,000 plus 10% of 10,000, which is 1,000. So you'll have 11,000 here. And what if you invest for not 1 year, rather you invest for 3 years? How much you will have at the end of the third year? Should I simply add $1,000 for each year? Because 10% of 10,000 is $1,000. So if you are earning interest of $1,000 every year, then the total should be 10,000 plus 1,000 3 times $1,000 for each year over a 3-year period. So that should give us 13,000. Is that the correct answer? Yeah, that would be the case, but no, this is not the correct answer. And the reason is that in the second year here, the bank will pay 10%. Let's assume the interest rate is 10%. But in the second year, you will get 10% on what? On your original amount, as well as that 1,000. Because you're not taking it out, you're leaving it in the bank. We call this you're reinvesting with the bank. So the next year, the bank is using your 10,000 as well as your 1,000 because that's yours. They want 10%. Bank is using that 11,000 in business. So it should give you 10% on 11,000. And similarly, in the third year, the bank should give you 10% on even more because then it should be 10% on the original 10,000 plus the 1,000 interest for the first year plus whatever the interest for the second year. And that would give us correct answer. So should we do the computation? No need to do this manually. We can do this through financial calculator. So bring out your financial calculator. I'm using Texas Instrument BA2 Plus. So we'll solve this in the financial calculator because we have it and we are allowed to use it in the exam. So I have opened my calculator. I'll be doing the calculation and I'll be showing you how it is done. So if you take a calculator, if you look at the top row of keys, buttons, there are 5. 3, 4, 5. The one that we want to look at is the third row from the top. This row has 5 buttons or 5 keys, and that's what we need to solve our problem. We want to know that how much this 10,000 will be after 3 years if invested at 10% rate per annum. By the way, remember this, whenever I write the interest rate, it will always be per annum. As far as CFA exam is concerned, you will never given rate which is for more than 1 year or less than 1 year. The rate will always be for the full year. Some students find it confusing and they say, what if interest payments are being made quarterly? Well, it will specify that the rate is 10%, but payments are quarterly. So it won't divide it by 4 and give you 2.5%. No, that does not happen in CFA. Never. You'll never see something like this. All it will do is it will say that this deposit or this investment gives 10%, but on a quarterly basis, which means that you have to understand that the 10% is for the full year, not for each quarter. I'll come to this topic in detail in a moment. Okay, so if you look at this third row, this has some keys. N is for number of years, so very simple. Okay, before we start providing, so basically what we're going to do is we're going to provide information to the calculator, and then calculator will give us the number. But before we do this, there is one important step that you need to do. Let's do that step, and then I'll explain why you have to do it. You have to, before every calculation, whenever you'll be doing calculation, you have to do this. And this key, as you can see, is the second function. So you press this second function, and then you press this FV key. Always, whenever you start calculation. So what's the benefit of that? If you look here on the calculator, you will see it says CLR TVM. CLR stands for clearing, deleting clearing. And TVM is the name for this set of keys. All of these, as I said, these are known as TVM, which stands for time value of money, but that's not important. So you press second function and you press FV. Now, why we have to do this? Because your calculator remembers. So any prior calculation will be already there, even if you turn off the calculator. So it won't forget. So you press second function FV to clear any information that is already there. Then you type 3, and then you press N. So basically, you're telling the calculator 3 is N, the number of periods. And then you type 10, and you press interest rate. Nice one. So 10 is interest rate. You do not need to type 0.1. 10 would be good enough. And then you type 10,000, and you press PV, which stands for present value. So you said, 10,000 is the present value. What else? You type 0, and then you press this, a PMT. This is PMT. What does this mean? Payment. Are we getting any money out of this investment every year? We are not. We're not getting any payment out of the investment because we have just informed the bank that the bank should reinvest that money. So whatever interest is earned should be invested again in the bank account. So we are not getting any payment. Okay, we have provided all the information. Now we want the calculator to do the computation. How? This is the key for CPT. CPT stands for compute. You press CPT first, and then you press FV. So you press CPT, and then you press FV. And here you get your answer. It is 13,310. And your calculator shows an asterisk here, which means computed value. And shows a negative number here, which I will explain in a moment. What does that mean? But for now, the key thing is this. So you see, because of earning interest on interest in the second and third year, our total value of the investment of the deposit has gone above 13,000. It is now at 13,310. This 310 was earned because of earning interest on interest. This earning interest on interest is called compounding. So in CFA, we will always be doing compounding. Very rare that you'll have any situation in investment where there is no compounding. Okay, see. Now, this kind of information can be given in different ways, and maybe you are asked to compute something else. For example, sometimes you will be asked something like this, that an investor wants to invest for 3 years at 10% and wants to have 13,310. How much he should invest today? So basically, you have the same data, but instead of providing you how much he has now, you are being asked how much he should invest now because he wants to have 13,310 in 3 years. Why he wants to have 13,310 in 3 years? maybe for his kids' education, maybe for constructing a house, maybe he wants to buy something, maybe a trip. So whatever is the reason, somehow he wants to have $13,310 at the end of 3 years. So how you solve that? You just do the same thing, the same process, but instead of providing 10,000 as present value, you provide 13,310 as FV, and then you compute present value. So the whole process is same. You provide inputs, and then you get what you need. So I'm not doing this. You can try. Just make sure you first clear already provide information. So second function FV to clear, and then 3 is N, 10 is interest rate, 0 is payment, 13,310 is FV, and then you compute present value, and you will get 10,000. But what I'm going to do here is another type of question where it says something like this. He has 10,000 now that he wants to invest for 3 years, and he wants the money to go up to 13,310. It's a very common problem in investment. We get clients as professional fund managers who say, you know what, this is what I have, this is what I want in 3 years. How should I invest? Where should I invest? What is the rate of return or interest rate that I should get so that my 10,000 becomes 13,310 in 3 years? Now we have an interesting problem. We have the number of years. We have the present value. We know there is no payment, and we know the FV. So we have all the information, but we want to find out the interest rate. So the same process will be repeated, and you will find interest rate. But there is a twist to it. So let's try, and you will see what is the twist and why knowing it upfront is better. So let's start with clear. Second function FV, you clear all previous information. 3, and then press N. This is what that we want to find out, so we do not know it. You type 10,000, and you press PV. 0 is PMT. 13,310 is FV. So you type 13,310, and then you press FV. And then you press compute, CPT, and press IY, interest rate. Oh, what do we get? Error 5. Yeah, very popular error 5. Why? It's a financial calculator. The calculator says, hold on, I do not get it. What is 10,000 and what is 13,310? If this is an investment, you are investing 10,000, so then it should be a negative number, so that I can understand that at time 0 you are investing 10,000 and then you are receiving 13,310. So calculator wants you to provide this number 10,000 as a negative number because it's in cash outflow. So how we fix this? We clear like our left bottom C, just simple clear, not the clear time element. Just on the calculator at the bottom, you have this CE. Just press this to clear the screen. You still have all the information in your keys already there. Just type 10,000 and then make it negative using to the right of it. Now we have a key plus slash minus. So just press this tree. That will make 10,000 a negative number. Now press PV. So you are providing calculator. You know what? We have to give away 10,000 as investing at time 0. Okay. Now what? Now compute interest rate. Compute interest rate. And you get beautiful 10%. See? This is how we use this third row to do the computation. Okay? What else in this fifth topic? of quants. Few more things. What if the question said that the bank has agreed to give 10% and interest payments will be every 6. So rate is again for the full year, but there will be payments every 6 months. So this is T1, end of year 1, this is T2, and then you have here T3. So it's still 3-year investment. The interest rate is still 10%, but you will collect or you can't collect payments every 6 months, which we will not. What is the benefit? What's the good thing about this? The second type of investment, B investment, is that in 6 months' time, when we get our interest and we tell the bank to reinvest it, we start earning interest here on our interest as well. So this compounding starts early. And the earlier compounding starts, the more interest we will have, because in this investment A, we were not earning any interest on interest in the second part of the first year, nothing. But here, we will start earning interest on interest in this time period. So how we solve a question like this, we want to know that how much we will have after 3 years. Well, very simple. What you're going to do is you're going to do, in this case, 2 specific adjustments. Instead of using 3, we'll multiply by 2, and you will use 6 as n. And secondly, instead of using 10 as interest rate, you will divide it by 2, you will get 5%. You will use this as interest rate. So basically, now we're telling the calculator that there are 6 periods for which we are investing. And each period has a 5% interest rate. Yeah, that's it. So let's do the process. So clear time variable 1 is second function FV. 10,000 is, sorry, 6 is n, though it does not matter. You can provide any information in any sequence. But okay, so 6 is n, 5 is interest rate, 10,000 is present value. I can make it negative. 10,000 negative is present value, and 0 is payment, and I want to compute future value. Now I get 13,401. Right. I ran it, oh no, you may see 400.95 or something. Okay, so you see, instead of 310, we got 401. We are getting extra money because the bank is offering us payments. The rate is same, it is still 10%, but because we are able to reinvest our interest early, it compounds to a higher number. So we are getting more benefit of compounding. Now, what if there was investment C, which offered quarterly compounding? Would that be even better? Yes. Oh, okay. So I'm not drawing a full timeline. You got the point. So quarter 1, quarter 2, quarter 3. This is time. But what if the rate is 9.8%? Now, which one is better? Is it better than B investment? Well, B investment has a higher rate, but it gives you interest every 6 months. Investment C gives you interest every quarter, which means better reinvestment, better compounding, but the rate is down. So how do you compare these? And what if, hearing all this, this investment bank, this bank say, you know what, on this investment, I'm increasing the rate to 10.2%. I'll still pay annually, but I will give you 10.2%. Now, which investment is better, A, B, or C? Okay. Now, how you go about it? We need to have some method to convert these rates into annual compounded so that we can compare with annual compounding. And your calculator provides you a very simple way to do that. Okay, yep. How you do that? Well, you press CE to clear the display, and then you press the second function, and then all the way down, digit 2. So when you press second function, digit 2, you activate interest conversion worksheet conversion. Because if you look at digit 2, if you look at here at the calculator, you will see it says ICONV, interest rate conversion. We are going to use this for our purpose. First, let's familiarize ourselves with this. So currently your calculator should be displaying NOM is 0. Now what you need to do is you need to press the down arrow key. Where it is at the top. If you look at to the right of computer, you have enter, then your up arrow key, and then your down arrow key. So you press the down arrow key, and you come across another variable. It says EFF. Okay. Whatever is, maybe it's showing 0 here. Press down again, the same. It says C/Y. And maybe it is already showing 2 or whatever. You press down again. And you go back to NOM. So these are just 3 variables in this sheet, and by pressing down, you can switch between these 3. Now what we're going to do is, we're going to provide this 9.8. We will type 9.8 and then press NOM. Okay, so let's go to NOM. Keep pressing down. Your calculator is displaying NOM. Now type 9.8 and press enter. This key, enter key. So 9.8, enter. Okay. Now press down. It says EFF, ignore it for now. Press down again. And it says C/Y. That's compounding per year. And because we have quarterly compounding, there are 4 payments per year. So we'll type 4, you will press enter. So you type 4, and then you press enter, this enter here. So enter. Now keep pressing down until calculator is showing EFF. And now press compute. So once you press compute, you get your answer. It says 10.17, 166.17. What does this mean? The calculator is telling you that if you are getting 9.8% quarterly, it is same as getting 10.17% annually. So which option is better? Investment A is better because investment A is offering you 10.2. 10.2 can be compared against 10.17. 10.2 cannot be compared against 9.8. EFF stands for effective annual rate. Effective annual rate. NOM stands for nominal. So nominal is, so if it is 9.8, nominal means it is with quarterly compounding, if it is compounding per year as well. Now, just like that, we can convert this 10% nominal into effective as well. All we have to do is we have to take care that the compounding per year should be 2 and not 4. Okay, so what else? So yeah, that's it. That's what. Yeah, by the way, these rates like 10%, 9.8. These are called annual periodic rates. And the rate that we get like this, these are called effective annual rates. So periodic rates are always annual. A is not necessary. You can drop it. Just periodic rate. Why A? Because rates are, in CFA we will always have annual. So even for quarterly compounding, you don't get quarterly periodic rate. There is no such thing in CFA. You will always, yes, the rate for the whole year. Here, you won't get 6 monthly periodic rate. That would be 5%. No, you'll never get that. you will always be given 10% with 6-month compounding, which it means that it's a periodic rate, period means 6-month period, but it has been given for the full year. That's my annual periodic rate. Okay, let's move to the next topic.